Welcome to DC, a crypto investor. Is crypto investing really just gambling? Many people think so, but the truth is, investing and gambling are very different. In this video, we'll break down the difference and show you how to make sure your crypto journey is investing, not gambling. Before we dive into the differences, let's first understand what gambling and investing really mean. Gambling is essentially placing a bet on an uncertain outcome, hoping for a quick win. It's often driven by chance and luck, with little to no control over the result. In the crypto world, this might look like buying into a new coin just because it's trending on social media, or making trades based on rumors without any real research. Investing, on the other hand, is quite different. Investing means putting money into an asset with the expectation it will grow over time, based on fundamentals and strategy. In crypto, that might be Bitcoin or Ethereum assets with strong networks, adoption, and real use cases. Investors don't expect overnight riches. Instead, they expect long-term growth, and they manage risk carefully. Now, let's explore the key differences between investing and gambling in more detail. The first key difference is time horizon. Gambling is short-term. You bet today and hope for a quick payout. Investing is long-term. You buy an asset and hold it for years, allowing time for adoption and growth. That's why investors can ride out volatility, while gamblers usually get wiped out during downturns. Consider this. A gambler might buy a new altcoin because they heard it might moon next week. An investor, however, might buy Bitcoin or Ethereum with a plan to hold for 5 years or more, believing in the long-term potential of blockchain technology. The gambler is at the mercy of short-term price swings, while the investor can weather market storms, knowing they're in it for the long haul. The second difference is risk management. Gamblers go all in on one coin, one trade, or one moment. Investors diversify, use strategies like dollar-cost averaging, and only risk what they can afford to lose. In gambling, risk is uncontrolled. In investing, risk is planned and managed. Let's break this down further. A gambler might put their entire savings into a single high-risk cryptocurrency, hoping for a massive return. An investor, however, might spread their funds across several established cryptocurrencies, perhaps allocating a portion to Bitcoin, Ethereum, and a few other promising projects. They might also use dollar-cost averaging, buying a fixed amount of crypto at regular intervals, regardless of price. This strategy helps to smooth out the impact of market volatility over time. The third difference is psychology. Gamblers are driven by excitement, fear of missing out, and the hope of quick wins. Investors are driven by patience, discipline, and rational decision-making. One group rides an emotional roller coaster, the other follows a steady path toward wealth. Think about it. A gambler in the crypto space might constantly check prices, feeling elated when they're up and devastated when they're down. They might make impulsive decisions based on these emotions, buying more when prices are high due to FOMO, or panic selling during dips. An investor, on the other hand, remains calm through market fluctuations. They stick to their strategy, make decisions based on research and analysis, and don't let short-term price movements dictate their actions. So, how can you avoid gambling and focus on investing? Here are 3 tips. First, do your research, understand what you're buying. Before investing in any cryptocurrency, take the time to learn about its technology, use cases, team, and market potential. Read white papers, follow reputable crypto news sources, and engage with the community. The more you understand about an asset, the more informed your investment decisions will be. Second, have a clear plan. Decide your budget, time horizon, and strategy. Determine how much you can afford to invest without jeopardizing your financial stability. Set realistic goals for your investments, whether that's a specific return percentage or a particular milestone you want to reach. Decide on your investment timeline. Are you in it for a year, 5 years, or longer? And choose a strategy that aligns with your goals and risk tolerance. Third, stick to discipline. Don't let hype or fear control your moves. Once you've set your plan, stick to it. Don't be swayed by market hype or FUD, fear, uncertainty, and doubt. Avoid making impulsive decisions based on short-term price movements or unverified rumors. Remember, successful investing is often about patience and consistency. If you follow these steps, you'll separate yourself from the crowd that treats crypto like a casino. You'll be positioning yourself as a serious investor, focused on long-term growth and wealth creation. Let's dive a bit deeper into each of these tips. When it comes to research, don't just rely on social media or influencer recommendations. Analyze the cryptocurrency's white paper, which outlines its technology and goals. Investigate the team behind the project. Do they have the experience and expertise to execute their vision? Look at the project's roadmap and assess whether they're meeting their milestones. Consider the competition and market demand for the solution the cryptocurrency offers. When creating your investment plan, be realistic and specific. Don't just say you want to make money in crypto. Instead, set clear, measurable goals. For example, I want to allocate 5% of my investment portfolio to cryptocurrencies, with the goal of achieving a 20% annual return over the next 5 years. Your plan should also include risk management strategies. This might involve setting stop-loss orders to limit potential losses, or deciding in advance at what price points you'll take profits. Discipline in crypto investing means sticking to your plan even when it's difficult. It means not panic selling during a market crash, but also not getting greedy and overextending yourself during a bull run. It means consistently dollar-cost averaging into your chosen assets, regardless of whether the market is up or down. And it means regularly reviewing and rebalancing your portfolio to ensure it aligns with your goals and risk tolerance. Remember, the crypto market is known for its volatility. There will be ups and downs, sometimes dramatic ones. As an investor, your job is not to try to time these perfectly. That's what gamblers do. Your job is to stay focused on the long-term potential of the assets you've chosen and to stick to your strategy through the market cycles. It's also worth noting that being an investor doesn't mean you enjoy the excitement of the crypto space. You can still engage with the community, follow the latest developments, and get excited about new technologies and use cases. The difference is that these factors inform your investment decisions rather than drive impulsive actions. Gambling is luck, investing is strategy. If you want to build long-term wealth in crypto, act like an investor, not a gambler. Stay disciplined, stay patient, and stay smart. For more professional crypto investing guides, subscribe to DCA Crypto Investor and continue your journey with us. Remember, the path to successful crypto investing isn't about finding the next get-rich-quick scheme. It's about making informed decisions, managing risk effectively, and staying committed to your long-term goals. Thank you for watching, and we'll see you in the next video.